welcome to our Flash Friday Finance, and we've got another update on accounting. I'm delighted to introduce Colleen Tarrant from Queensland, actually, but works with the BANTACS group, who are a national accounting group. And Colleen has been a friend of mine since very early on. I knew her, Colleen, before she was an accountant, actually. One of the reasons why we're having this chat is to give people advice on how to get the best out of your accountant at this time of year. And of course, we'll have the general disclaimer, which is, of course, this is general advice, and we're just, if you want proper advice, please feel free to call Colleen. That'd be great too. And I'm sure she'll have some details. So, Colleen, first off, welcome. Thank you for joining me.
Thanks, Louise. Thanks for inviting me. You know I always love to talk tax and investment properties and things like that.
It's true. We love talking. We would love talking with you too, though. Not just on tax, thankfully.
Yes.
So can you please tell us a little bit about how you got into accounting and what you do, what's your business like, and explain a bit about that for us. Your history in accounting.
In 25 words or less.
Yeah.
Well, as Louise said, I really started off in accounting by accident. I really wanted to be a journalist. So writing the blogs has been really great for me. But I just enjoy accounting. I enjoy helping people. I enjoy reducing people's tax. I enjoy talking about investment properties. And I've been doing accounting for quite a long time. I'm not going to mention the number of years, but I've dealt with not-for-profits, I've dealt with retail organisations, all different types of businesses, listed companies, and I'm in public accounting at the moment. As Louise said, I'm in the BANTACS group, so investment properties is really my thing, and under my company name, which is Innate Business Advisory, I like helping businesses, particularly businesses on zero, and it's been a particularly challenging year.
Not zero income, but zero the software.
Exactly. Yes. So yeah, helping them all. And I think, Louise, you know, you'd have noticed this with your clients, that it's been a really challenging year. I mean, there were tax changes affecting us already since the 1st of July 2019. And then COVID hit, and it's affected so many of our clients, so many. Some businesses have actually gone gangbusters, and others are really struggling, and I really feel for the ones who are struggling. So hopefully we can help a few people today to, you know, maximise their tax deductions legally, of course.
Yeah, of course, and get the most out of it. Well, that's right. And Colleen, you also had experience in a prior business with valuing businesses. So you had quite a bit of experience about knowing where the money is in businesses, didn't you?
Yes, and how to build value in a business. And I just did another valuation last week, and it's amazing the difference between when a business prepares for sale and when they just put it on the market and plonk it there and expect a really high price. So yeah, it's just really interesting, you know, seeing your value in a business and valuing the businesses you're helping on an ongoing basis, and seeing that growth and that value building over time.
Brilliant. Okay, great. And I know you've really you have prepared a presentation for us because you're wonderful. Would you mind to share your screen, and I'll let you go for it?
Okay. Now, this is all general advice, as Louise has said, but what I've noticed in my own client base and from questions that people have been asking me this year, because it's such a different year, there's a few stings in the tail in the 2020 tax year for individuals. So we're just talking about individuals here, we're not talking about businesses. And the first one is the COVID home office claims. Now, I know there's been a bit in the press about here, but people are still confused when they're getting their tax records together and how to prepare for it. The ATO is going to be looking very closely at all things like uniform claims, which should be reduced this year if you've been working from home, and what people are claiming. And I know there's been clients who have asked me, can I claim my home mortgage, for instance? So there's just a lot of questions on how can they claim and how can they recoup some of their costs that they've spent in working from home. So I just wanted to go through just a few basic things with these. Now, since the 1st of March, the ATO, in its infinite wisdom, has given us an 80 cents per hour claim for working from home to make things easier for taxpayers. So you can claim 80 cents per hour, and there's not as many stringencies on what you can claim in this area. So it applies from the 1st of March 2020 to the 30th of September, unless they extend it, of course, if you're working from home instead of in an office and you've incurred expenses. So the good thing about that 80 cent per hour rate is you don't have to take into account other users of internet and electricity. So if you've got your partner at home working on the internet and the kids are watching Netflix or doing online study and you're working in the office, you're supposed to take into account their use of the internet, before you can claim. And that's pretty hard. And then you don't have to have a separate area within the home with the 80 cent charge. You still need a diary and a timesheet to justify the hours worked, but most people have to do that. A lot of people have to do that anyway. Now, the sting is, and this is what a lot of people don't realise, you can only claim the 80 cents per hour worked according to a diary, and you can't claim anything extra. So you can't claim your phone on top of that, you can't claim your internet, you can't claim your electricity. If you're depreciating a computer, you can't claim this on top of your 80 cent per hour claim. So what we're finding is when we compare the actual method, which we're going to discuss in a moment, to the 80 cents is, unless your work has provided you with a laptop and all the equipment that you need and everything, so you don't have any of those extra claims. Maybe they're paying for your phone as well. It's probably a good claim for that because you don't have as much compliance with it. But we haven't found very many cases where this 80 cents claim has been better than claiming their portion of internet using a diary.
Right.
So be very careful when you claim that you don't overclaim for other costs on top of the 80 cents. But it is easier to comply, particularly if you've had the whole family, using the internet and electricity at the same time that you're working.
Great advice. Terrific.
Yeah, so your accountant should be able to distinguish. And in fact, some of these home office claims are very time consuming to work out. So the actual method can be applied all year, including the COVID period, as long as you have the records, if you're working from home instead of an office and you've incurred expenses. So with this method, you do have to take into account other users of internet and electricity, and you do have to have a separate area within the home. And you do need the diary and the timesheet to justify the hours worked. Now, the ATO is asking for both a 30-day record pre-COVID and a 30-day record during COVID. And, some people have done this because BANTACS has got a diary page and our clients have access to that. But I'm not sure how many people who have lodged their own tax return will have that if the ATO comes knocking. And you can't claim home loan interest and rates if you're an employee working from home, only if you're running a business from home or you're running a real estate business.
What does the separate area in the home mean? Just separate to what?
Well, if you're just using your laptop on the kitchen table and, the kids are doing a jigsaw puzzle at the other end, that's not counted. But if you've got a separate home office, like a lot of us working from home full time would have, then, that's completely separate. I mean, there have been historical cases where someone had a sofa bed in their office and then the ATO came knocking and apparently they knocked it back because it was used for other things other than the office. You don't know really what the ATO is going to ask.
That's rough, isn't it? Oh.
It is very rough.
Sofa bed in the office, actually. I'd love one. That's a great idea.
Well, yeah, the problem is that the ATO always thinks that we've got lots of time for all this compliance, but really you do need to have all this stuff. I've had the ATO calling about a couple of things and claims, which have turned out to be totally legitimate because we check a lot of things with our tax returns, but you've just got to have all your paperwork in order and the substantiation. And some people say, I think, I claim 90% because I hardly ever use it for private use, and trying to persuade the tax office that that's actually the case without any hard evidence. It's really hard. And then, you look at most mobile phone bills and it's an all-encompassing, all calls included rate and, data's included. So working out, what's private and what's not is actually very difficult. But at least if you've got your 30-day diary record, you should be able to prove it okay.
Great.
Yeah, so apportioning all those things is really a sting. And the ATO is also looking at receipts paid by someone other than you in order to deny a claim. So if your husband's paying the bill, or your mum, or your father's paying a bill, and you claim it and the ATO checks and they can't see that you've actually paid it, there's a very strong chance that they'll knock that back. And if you look at the audit resources that the ATO's got compared to your average employee or small business, the ATO is going to win hands down every time. But if you've got the records, the ATO has been incredibly accommodating in the past few months. And just like everyone to know that you do actually have to have that paperwork to claim those. Just to help people, this is what we ask on our checklist. So we've got a comprehensive checklist for individual taxpayers, and really you need, if you're going to claim using the actual method, you've really got to be pretty exact. And we need, if you've bought a new laptop to use at home, we need a copy of the invoice and a diary to support the use. And it's all a bit of a pain to start off with, but really it's only a 30-day diary record. It shouldn't be too bad. If you're working full-time from home or 2 days from home, just keeping those records could mean the difference between only a few dollars claim or a really good claim, a legitimate claim. Yeah, so that's a bit of a difference this year in how many people are claiming home office. So Julia Hartman, the head of BANTACS, back a couple of months ago, wrote a blog on working from home, and you can see from the little picture that working from home is not exactly the same for everyone, but it covers a lot of things, going into more detail than I can go into in a 15-minute presentation. But if you can keep the records, it's just like anything else in tax. If you can keep the records, you're going to have a much better go at maximising your tax deductions.
Right, thank you.
We've also got a simple diary on our website, and at the end I've got a link where you can download it from, and that's just a 30-day diary, so you can prove when you were using the internet and when you bought things and when you were using your phone and all that sort of stuff. So that really helps as well.
Wonderful, thank you.
Now, the other thing that's really got a sting in the tail is investment property owners, and haven't there been a lot of changes, important changes in the last few years? It's like there's this big target in Canberra and it's got investment property owners on it, and they've just been targeting it. I mean, the first thing was the travel. You can't claim travel anymore. And that was bad enough, but I don't think we kicked up enough of a fuss when that happened, because the next year they changed other things, and these changes are still affecting people now. The biggest sting this year, the sting number one, is land and building losing the tax deductions during construction. So if you want to claim expenses while you're building, if you're doing a land and building construction for your investment property, what you used to be able to do before the 1st of July 2019 is claim your interest, your holding costs, your rates, etc., while you were building, because it was an investment property. So from the 1st of July 2019, if you're buying house and land for an investment property, you can no longer claim those costs paid by you on the bank loan. You can only start claiming them once the property is completed, the construction, and it's available for rent. Now, that's a really big change, and it can cost people a lot in deductions. So with a land and building contract, you can still save on the stamp duty because you only paid on the land, not on the building construction. But because this is a big change, the tax deductions aren't so great while you're still building. So the non-deductible costs will add to your property cost base, but really that's only going to benefit you when you sell the property, and most of our clients keeping them on a fairly, at least a medium-term basis. So not now. The deduction's not now. So if you were constructing a property, say on the 1st of January 2019, you would have still been able to claim the interest and the holding costs up until 30th of June 2019. But say it wasn't finished until November 19, you can't claim it from the 1st of July to November. So it's been a change this year And, some people aren't expecting it. So they come usually to our office once they've
already done
purchased it. They've made all the decisions. And they still do save on the stamp duty, and they do get a nice house, and it's still got all the depreciation provisions and everything, which are great tax deductions, particularly in the early years. But you can't claim those holding costs anymore. So if your house takes a long time to build, or if the construction company goes into liquidation, which is, probably worst case scenario, you could be incurring non-deductible costs, which could murder your cash flow and your family savings. So that doesn't happen every day, but it is a risk, now that change has been taken place. And, potentially could really hurt your cash flow for a long time. And that actually happened to one of my clients. The first builder went broke. But, luckily for her, that was still when you could at least claim some things on tax.
Awful.
Yes. So that's been a big adjustment this year. And I like people to know about that because, not always, if they're talking to a construction company, for example, or a builder, they're not going to tell them about this stuff. And so they really need to work out, or ask their accountant to work out, will it be better for me to do land and building, or it's going to take this long to build and this much, or should I buy a completely new property and just get all the tax deductions right from scratch? And that's what some of our owners have done, with their latest purchase.
Totally.
So that's sting number one. And sting number two is converting your principal place of residence to investment, and I've had 2 this year. So because of the changes a few years ago, if you're in your home, you might not know at this stage, if you buy some new plant or equipment, new carpet or something in your principal place of residence, and then you make it available for rent as an investment property in January 2020, you can't claim that plant in your tax return even though they're relatively new, because it's been used for private use before you turned it into an investment property, an income producing one. So you can only claim, if you change your principal place of residence over to investment, you can only claim the building items at 2.5%. So that can still be a good claim, and really you should find out, if this is in your case, find out if a depreciation report will be of benefit to you by inquiring of a reputable firm. And we have a few that a lot of our clients use if people are interested, but you just need to ring them and tell them the details of your property, and they will tell you if it's worth getting one or not. And it depends how old your property is, how recently it's been renovated, and a number of other factors.
Actually, on that, Colleen, I had a client tell me yesterday they've been charged $2,500 by an accountant to do a depreciation report for them, including furniture and things. I said, oh my God, they could have got a professional quantity surveyor to do it for $500-600. Absolutely outrageous.
Yes.
So you've got to know who to ask, and that's why both of us are in this game. Like, we need to help people get the right advice and not let them get ripped off from people who don't know really what they're doing.
Yes, yeah. Look, that happens quite often actually. When we get new clients, I ask, have you ever thought of getting a depreciation property? And they say, no, what's that? And then you say, look, talk to someone. They get a depreciation report, and it's thousands of deductions that they've been missing out on because they didn't think it was worth it.
Oh, yeah. Absolutely.
Building depreciation goes for 40 years.
You need a proper quantity surveyor to do it, though. Then,
Yes, you do.
Great discounts at one of the guys. They're terrific national companies. So make sure you call us and ask, because it's
Definitely, and it's tax deductible as well. It's tax advice, so it's tax deductible. So really, after tax, it's not going to cost you that much compared to the deductions you'll get from it. Yeah, so what you need as well, when you convert your principal place of residence, your own home, to an investment property, you need to get a market valuation, assuming you bought it as your home to start off with. And then that's your cost base. So, assuming you go to another house and you declare that as your principal place of residence, this is the cost base. So it might have only cost you, I don't know, $80,000 when you bought it back in 1980. But when it's transferred over to an investment property, you get the market value. So it might have gone up to, I don't know, $900,000, and that's your new cost base. You really don't want the old cost base. And the market valuation, you don't have to get a registered valuer. You can just get a real estate agent, as long as you've got something in writing that substantiates the market value.
Can you use the rates notice per chance?
You can, but it's not often a good judge of market value.
So you want it as high as possible, because that way you're affecting your capital gain tax. So obviously, yeah.
Of course, you want a high value, but you're not going to diddle the figures or anything. It's got to be the actual market value.
A rates notice might be lower generally than what you'd hope the open market would give you.
Well, yes, I guess you can look at the rates value, and then you'd ask your real estate agent. They've got access to all those reports and everything, and they can print it out and get a backdated valuation. And actually, you can at BANTACS as well get a report printed for a backdated market valuation. But you really need that, and then you need to keep it, because that's part of your capital gains permanent file for your property.
How long do you need to keep that sort of information?
Well, basically, after 5 years, you need to keep it until after 5 years you've sold the property.
So you've sold the property, and then for another 5?
Yes, because you've got to keep the 5-year records for the tax office. Now, what we've noticed, and this is confusing for a lot of people, I know, some of those depreciation reports, there's probably 2 things there. Some of them are still itemising plant and equipment. So the client looks at all those listed things and say, why aren't you depreciating those items? And they actually can't, so I don't know why they're putting it on there. All we need is the building in those cases. And then, after that, whatever they buy for the property is just like a normal rental property. But that can be confusing. So just watch out for that. And also watch out for depreciation reports which are 100% when you've got a breakup, say like 99-1 ownership, where one owner owns 99% and the other owns 1%. You can basically write off any plant. This is just generally, but you can write off the 1%er or the 10%er in the very first year. But if you've got 100% report only instead of individual reports, it won't take that into account. So you get much better depreciation if you get separate report.
Good idea.
Yeah, so there's a lot of things. Louise and I both have a lot of experience, personal and professional experience in all this area, and it hurts us when people don't take advantage of some of these tax breaks. So call us if you need to. There's nothing that hurts an accountant more as some wasted tax deductions.
Very good point.
Yeah, so that's just a few stings with the 2020 year. So to help people, because I know not always easy to keep a record of your rental property, and the more organised you are during the year, the better off it'll be for you and your tax. So Julia Hartman, again from our BANTACS property group, has formulated this property tax return worksheet, which you can use for a number of properties, and normally that sells for $15.95, but we're making that a handout at our blog page as well.
Oh, great. How cool. That's
yeah,
it's
a really good comprehensive worksheet. And the good thing is that next year you can use the same, you copy it over obviously, but you can use the same one for the next year as well. So it's even at $15.95, it was fabulous value.
Fantastic. That's brilliant. Thank you very, very much. Well, we'll put a link to that on the bottom of this page in the transcript. So thank you for that.
And there's no sting as far as this offer is concerned.
Naturally.
Yes, that's right. So if you need to contact us, please do so. There's my mobile phone number and our 1300 number that our reception answers, and that's our blog page for your free downloads, and we're going to have those made available after this webinar. So always happy to talk to new investment property owners and businesses on Xero, and happy to help out with any webinars in the future, because as you know, I love talking tax.
You do.
So thanks, Louise. Thanks for the opportunity to talk about this and hopefully get the word out to some people that there are some stings this year, and yeah, try and avoid them if you can and get your records right before you lodge.
No, you did a brilliant job. Thank you, Colleen. I really enjoyed that. And, we learnt lots. I even learned something. And it's great to keep up to date because it changes so dramatically. It's
Every year it's
hard
changed.
for people. Yeah.
Mm.
And I don't know how you bother doing it if you were, you know, not getting professional advice. It's crazy. But getting the right professional advice, not just feeling like you're getting pushed through the mill. So brilliant. Thank you so very much.
Have a great day.